to Small Gold. In case you missed it, top gold and silver stories for the week ended August 27th, 2016. Fed orchestrates another yak attack to reflate the dollar index. We're going to go through what happened this week and how, in the continuing way, the Federal Reserve and other central banks continue to influence the market by talk, and also we'll see by action. Top story of the week, I think, from a political aspect was the revelations regarding the Clinton Foundation, showing clearly that there is a relationship between the donors to the Clinton Foundation and the access they had to Hillary Clinton and the State Department. The top economic story of the week, as we mentioned, is the continued manipulation of markets by the Federal Reserve via open mouth operations, which I like to call yak attacks. I did a poll of Small Gold subscribers, and I just want to share those results with the subscribers and those of you who are not subscribers but follow the smallgold.com blogs, and also who follow Small Gold on the various social media sites. So the first question I asked the Small Gold subscribers, remember this is a subscriber only survey, was which topics interest you the most, and it turned out that gold news was indeed the most popular, followed by the general economy. Silver news was third, real estate news was fourth, politics was fifth, music, popular culture, offbeat type news was last. Some interesting points though was gold was selected in the top three responses by 94% of those surveyed. The general economy, however, was the number one, was selected the most by 40% of the Small Gold subscribers. And silver news, surprisingly, although it came in third, more than a quarter, 28%, selected silver as their fourth choice. So the devil's metal is not as loved as I might have thought on smallgold.com. There was support for it, as you can see. The overall average was pretty high, but it still came in third behind the general economy and gold. So gold maintains its crown as what you guys are interested in, or at least what the subscribers are interested. Now, if you're not a subscriber, you can become a subscriber just by going right up here, filling in your email address, and you'll become a subscriber, and you could participate in the next poll. Where do you follow smallgold.com? This was interesting. Only 38% of people who subscribe to Small Gold follow Small Gold on YouTube, so there's not much of a crossover there. Twitter, only 28%, Facebook, 8%, Google Plus, 6%, and Pinterest, nobody. So, and the people on Pinterest, I guess, are a totally different audience. They check out all the Small Gold charts over there, but no one that's a subscriber even bothers to look over there. Or really, less than half even go to the YouTube channel. How do you find the quality of work on Small Gold? I was happy to see this, at least, that 98% of those that subscribe to Small Gold, which makes sense, otherwise why would they subscribe, find the work on Small Gold to be of the highest quality or pretty good. 53% said the highest quality, 43% said it was pretty good. I did have a few that said it's okay if I have nothing else to read, and that was 2%. Maybe they just said that because they thought it was a cute answer, but I do think that someone could see that perhaps that the quality could be better. The last answer, which nobody picked, was poor. Not sure why I'm still subscribed. Again, if you're not a subscriber, you can sign up at this link or up at the top. Okay, let's get to the stories of the week. Gold and silver. Gold closed last week at 1320, down 1.5% from 1340 last week. The bigger drop was in silver. Silver closed at 1865. From the week before, where it closed at 1925. What that did was push up the gold silver ratio back to over 70 to 1. It ended the week at 70.8 to 1 after having the last few months moved below that number into the low 60s. Here's the chart of the week, and it's kind of the touch point for what we're going to talk about in Fed yak attacks. The dollar index and how the Fed uses open mouth operation and yak attacks to orchestrate where it wants the dollar to go. This is Friday. Now remember, Friday, we're going to go through this chronologically. We'll see how the week develops. And when we get to the bottom of this blog post, we'll cover specifically what happened on Friday. But I'll give you a precursor of what happened here. So here you see the dollar index is in the low 94s. And the prior yak attacks had not really succeeded. You had Fed President Dudley, Fed President Lockhart, Williams last week, earlier this week, talking about rate hikes in September, and that had a temporary effect of boosting the dollar index a bit, but it kind of fell down because everyone's heard this story before. Lots of talk, no rate hikes. And as the day was going on, Thursday evening, Friday, the dollar index was basically kind of mired in the 94.5, 94.6 range in anticipation of Janet Yellen's speech on Friday, where people thought at Jackson Hole she might say something that might give an indication whether September is on the table for a rate hike. A rate hike is on the table for September. And the initial response to her speech, when people scanned it and the algos looked at what was said, was it looked like she was talking about a strengthening economy, and it looked like, yeah, why not? Let's do a rate hike. And you can see right here when the speech gets released, the dollar index shot up, but then shot right back down. And the reason for that was she had tucked some language into her speech while she was saying the economy was strengthening. She was also saying that future policymakers might want to consider $2.1 trillion of QE in the future and keeping interest rates lower for longer. Now, that was kind of a bombshell because while Janet Yellen has spoken about negative interest rates in the past, she's never explicitly mentioned, hey, why not do another $2.1 trillion worth of QE? Well, that sent the dollar index back down because I thought smartly that markets were, instead of focusing on this, what's right in front of their face, which is maybe there might be a quarter point rate hike, which is basically irrelevant, that she's talking about a $2.1 trillion hypothetical, more QE in the event of the next recession. Which, why would she be talking about the next recession when she's talking about the economy strengthening? But in any event, I was happy to see that immediately that became the story. So you got this big rise and bam, right back down. And then on cue, but this was already scheduled, Fed Vice Chair Fisher, who was scheduled at 11 o'clock, I think Yellen spoke at 10 o'clock. He was scheduled to speak at 11 o'clock on CNBC. And of course, what does he say? Oh, yeah, what Janet Yellen says is she's talking about possibility of September rate hikes. And then boom, the markets focus again on the short term, what's in front of their face. They forget the fact that, there's this realistic chance of another $2 trillion worth of QE coming down the pike. And the dollar index goes back up a full dollar. It's a big gain. And again, it's mission accomplished. The Fed managed to convince market participants what they do in the next few weeks is more important than what they've done the past 10 years, which is no rate hikes and printed $4.5 trillion in zero interest rate policy. But the most important thing now to the markets is, as you can see, they reacted, is what the Fed might do in the next few weeks, which is possibly raise rates a quarter of a point in September. All right, let's look at the stories we covered during the week. We don't go through all the stories. There's a lot of good links here. The way you access those is you go to the website and you check them out. I only try to stay on a theme as to what we discussed during this podcast, but there's plenty of gold and silver stories that are linked, some that you might not have found elsewhere on other sites, so please check those out. So on the 22nd, now Fisher's not foolish. He didn't just speak on Friday, he also spoke at the beginning of the week, and he was saying that the Fed was closer to its goals. And again, closer to its goals mean rate hike imminent, because if the Fed has done its job, then of course they're going to raise rates because inflation is on the rise. They like inflation towards its 2% objective. There's full employment. The economy is robust, solid, and so on. So Fisher kind of primes the market for later in the week when he speaks again after Yellen's speech that he's already indicated the Fed is close to its goals. And remember, he's piggybacking off on the prior week's comments by Fed Presidents Dudley, Lockhart, and Williams that yes, the Fed is indeed ready to go with rate hikes. Cashless, I will mention this one. Korea's might be going coinless, or is announced it's going coinless by 2020. U.S. Mint sales updates, they remained depressed, especially on the silver side. I won't go through them, but you can see on the blog post by the end of the month so far, or by the end of the week in August, that the U.S. Mint has only sold about 1 million American Silver Eagles, about 37,000 American Gold Eagles in the 1 ounce form. The Gold Eagle sales aren't bad. The Silver Eagle sales on a comparative recent basis are very, very poor. Let's go down to the next of the 23rd. There's some stories about gold recycling, gold smuggling in India, gold piling up in Singapore vaults. There's an interesting story about gold used in nanotechnology to help fight Alzheimer's disease. There's some interesting stories about people dredging for gold in California and the ban that they have there. Now, this one is important. The Bank of Japan, Zero Hedge had a story on this. Well, this was Zero Hedge did have a story, but this link is to CNBC, which I find is more interesting because Zero Hedge tends to be more clued in and on the alternative side. On the mainstream side, CNBC normally doesn't mention anything other than buy stocks. But they mentioned that the Bank of Japan has nationalized the stock markets, and that's been kind of my analysis about why the central banks are not losing control. They may be losing their effectiveness, but they're not losing their control, because when the Bank of Japan buys, is a top owner of the top 20 stocks in the Nikkei, that's right now, they are kind of taking over the market. And the CNBC article mentions that they are, in effect, nationalizing the market. So I would say that they are perhaps losing effectiveness in terms of being able to impact the economy and make it better, which they should not be even trying to do. But they're not losing control over the markets. They're gaining more controls. We'll see later in the podcast the other things that central banks are doing. The U.S. economic data, again, not very good. You got Richmond Fed down, the marketing manufacturing PMI was down, but new home sales. Now, this is another example where I needed to point out. New home sales were at 654,000 on a seasonally adjusted basis, and they were bragging this was a robust, solid indication of strengthening economy, highest home sales since 2007. Started to throw cold water on the headlines, but 654,000 homes sold in a given month is the highest that it's been since 2000 in the 2010s. The highest it ever was in the 1960s was higher, 665,000. We have seen peaks more than twice that amount in the 2000 and 2005. You had 1.389 million homes sold. So this 654, whether you believe it's a fabricated number or not, even if it's 100% accurate, it's still a horrendous number given that the population of the United States is 60% larger than it was in the 1960s. But in any event, that shows momentum, it shows strength. If you're interested in housing, if you click on this link here, you can get a full explanation in a 5-minute video that I did on this showing the peaks and valleys of new home sales. Again, you can look at the U.S. Mint sales update on a daily basis at the blog post. We'll scroll right past that. On Wednesday, I spoke with Jason Barak of Wall Street for Main Street, and we did about a 45-minute podcast, the bulk of which discussed how Fed yak attacks support the dollar. There were some other topics discussed, but if you have the time, it's worth checking out at this link or going over directly to Wall Street for Main Street's YouTube channel. It's still up on the channel. You can check that out there. Here's the podcast if you want to check out the analysis on home sales. So you can see in 2010, there were 220,000. They're only up to 654. That's touted as a great recovery in housing, but really there's a lot of room left to go before they can claim that new home sales are really robust. Now, also on the 24th, on no news, gold was slammed down. There you go. Bam. Another reason I say there was no news. It all happened in a few minutes. And the reason I say or I criticize those that are saying the powers that be, the cartel, are losing control. No, not when they can do that. Not when they can just dump contracts. I think Zero has looked at it as $15 billion worth of notional gold sold in 5 minutes. Well, yeah. I mean, if they have the ability and they have access to either print money, borrow money, and just sell gold that they don't have, it's in control. Now, it it does perhaps lose its effectiveness to a certain extent, that people realize that these slam downs, they do destroy sentiment, but then the sentiment comes back and people buy more. But they can keep doing this, and they have done this, and that just ties into my concept that they're not losing control. They do it with impunity. There's no manipulation charges. They have actually cases that say just because someone is stupid and loses money on a trade doesn't mean they're manipulators. And that makes sense kind of logically, that people are free to do stupid things, because you would not want, as a legal principle, that anytime a business person does something stupid, that somehow it's illegal. And there's a thing in law called the business judgment rule, where courts are very wary to make judgments based on the business judgment, because they're not supposed to second guess business owners. That makes sense, except that can be abused, because now you can, with impunity, if you've got money, you can just, if you want to drive the price of the stock of the gold market down, so you lose money. You've accomplished your goal. And the courts are going to say, well, that's not evidence of anything other than perhaps someone who doesn't know how to trade. But if he does it enough, there's a pattern. There was another theory that perhaps my theory is that they wanted to drop the gold price and boost the dollar index before Yellen's meeting, because in case Janet's comments were misinterpreted, they wanted to have already knocked gold down a bit, and they wanted to have boosted the dollar. But there's another theory, which I thought makes sense, is that someone wanted to drive down the mining shares even further, and they could do that by hitting the gold price. And then when the gold, I think it was Peter Schiff who said this, when the gold mining shares went down, their stops would get taken out, driving the prices down lower, which would give an opportunity for a new entry point for a lot of the big money that has been buying, as we'll see later in the podcast, gold and silver mining shares. The stories we saw leading up to Friday, and Reuters is propaganda machine for the Fed and for the administration, that expectations the Fed will hold off on further rate increases have been behind a more than 25% rally in gold this year. What they're trying to say is that the only reason gold is up this year is that the Fed has been holding off on rates. But hey, we're going to tell you that's not the case. So if the reason gold hasn't gone up, the reason gold has gone up this year is because the Fed has been holding off on rates, well, get that thought out of your head, because here come rate hikes. They're on the table in September. They're talking about 2 this year. So forget your gold, boost the dollar, rate hikes are coming, economy is solid, robust, and so on. And this is what the Fed's talking about, and we're going to backstop that story. Now, what did Reuters have to say about existing home sales? Now, existing home sales went down. New home sales went up. Okay. But how does Reuters spin the fact that the existing home sales declined? This is, I always say, solid and robust. That's because they always say that. Further gains in prices suggest the housing market remained on solid ground. Their words, not mine. The housing market and robust consumer spending are expected to underpin economic growth in the third quarter. Expected. They use the word expected as if everyone expects it, not some economists expect or we expect as Reuters cheerleader. No, the housing market and robust consumer spending are expected to underpin economic growth in the third quarter. So you see they're carrying water for the Fed. They know that the first quarter was bad. They know the second quarter was bad. They know that the existing housing sales were bad. But robust consumer spending is expected to underpin economic growth in the third quarter. Okay. Another U.S. Mint sales update. We can check that out. We reported on the Canadian Mint half-year sales. Now, the Canadian Mint doesn't report on a monthly basis like the Perth and U.S. Mint, so we have to get their sales on a kind of delayed basis, and they're very good. I mean, the first half of the year, they're ahead of last year's record pace. But one of the things they mentioned in the reports, and I did a separate blog post on this and separate YouTube on this, was that they did not see any pickup in June after the price rose after the Brexit vote, and any pickup in sales. So just like the U.S. Mint, where they saw kind of a slowdown in June, but a real slowdown in July and August, I probably think that's going to happen at the Canadian Mint as well. But for now, very robust numbers for the Canadian Mint. In silver, gold, high prices deter Hong Kong gold imports. That's something I've been talking about all years, the divergence between the paper demand and the physical demand. There has been a lot of momentum playing with the Western traders moving into ETFs, buying gold futures contracts, silver, so on, silver ETFs, silver futures contracts, driving the price of gold and silver higher, which has had factually an impact on physical gold demand in the East. Shanghai Gold Exchange withdrawals are 25% lower. They're mentioning here Hong Kong gold imports are lower. It's because of pricing. Indian imports are also lower, not just because of the 10% duty. There was a 10% duty last year. Gold imports are higher. When the price rise, physical buyers get smart and they just slow their purchases. Let the Westerners boost the paper price. There'll be another slam down and then they can buy more physical. But for now, physical demand is down because of higher prices. Dan Popescu, he is a gold analyst. He is Romanian, I think, by nationality. He's reporting the largest bank in Romania has sold 3 tons of gold to customers over 8 years. So interesting to see the Romanians buying gold in physical form directly from their bank. Now, I did just mention that Indian gold demand had been down. It was up 20% in August, but from the prior 3 months after it is falling sharply from May to July. So perhaps we're going to start seeing some pent-up demand in India, because India also has its gold buying season later in the year, and also because prices have been so high and they've deferred purchases. If they think that the prices really aren't going to drop much further, then we might see a real pickup in gold demand in India later in the year. But gold consumption fell 18% in the second quarter of 2016, and it's largely due to rising gold prices. But these aren't my words. This is the Economic Times of India. Not reduced underlying demand, which means the demand is there. They want the gold. It's too expensive. And then they say with the Festival of Marriage season fast approaching, gold demand is expected to surge again. Okay, hope it does. Gold investment demand takes over jewelry demand. That was from Bloomberg. That's exactly what I've been saying, and the World Gold Council confirmed a couple of weeks ago, is that for the first time, the investment demand overtook the jewelry demand. Normally, jewelry is the number one physical buying of gold, but as the price gets more expensive, and jewelry is a discretionary item. You don't have to have jewelry. If it's too expensive, you wait till the price comes down. War on cash. Danes stockpile cash. Very interesting. Now here's something. Central banks eye infrastructure spending to plug next investment gap. This is from Reuters. About 2 years ago, I had done an article and a podcast about our infrastructure bonds next. And I viewed that as the Fed and now central banks blame shifting. They've done all this printing of money and the economy hasn't improved through their intervention. So now what they want is Congress and countries to increase their infrastructure spending to try to fix things. And of course, they'd be more than happy to monetize any of those bonds, I'm sure, that might be issued for infrastructure projects. Now, central banks, this was in zero hedge. Central banks now own 25 trillion in financial assets. And those are not just government sovereign bonds, as we'll see. Those are US equities, Japanese equities, private issued corporate bonds, And the thing is, if they own 25 trillion worth of financial assets, that means they've got a good control over the market. It also means, what's to stop them from doing 50 trillion, 100 trillion? So this losing control argument, again, I don't buy it. I say losing effectiveness, but the more they buy privately issued corporate bonds, US equities, Japanese equities, whatever they buy, they in effect start to become the market. And this concept of economic mother nature taking over, that's assuming there's still a free market. If, as they say, as we saw above in CNBC and also at Zero Hedge point out, they're nationalizing the markets, they don't lose any control. Nationalized markets means they own the markets. They totally control the markets. De-dollarization, I always like to point this out when it comes up. Poland issues panda bonds. So we're starting to see the yuan pick up as there was this SDR bond, redeemable in yuan, that was issued a week or so ago. So we're starting to see international finance move towards, in some degree, towards the Chinese yuan. Okay, now, Norway's central bank files for confidential treatment of its U.S. equity holdings. I've already done, and you can check out on the smallgold.com website, a blog post on this and a video, but I'll briefly touch on it here. My research showed that the Norwegian central bank, just like the Swiss National Bank, owned, and this is over a year old, because they have an arrangement to keep their share purchases confidential with the SEC, but they own about $1 billion of mining shares too, as of June 30th, 2015. They probably own more now, but the fascinating thing is, A, why does the Norwegian central bank own U.S. equities? And B, why do they own mining shares? That's not the purpose of a central bank, to be a stock market player. But again, you can check that out at this link here, and you can also see what they own on the chart. Canadian Mint also, we mentioned above, they sold a record amount in first half silver. They are selling a decent amount of gold as well. You can check that out at the links here. Now, the GDP number comes out. It's 1.1%. And my initial reaction was, Reuters going to say something foolish like, but economists say robust and solid gains will drive growth in the second half. And I was just waiting for them to finish their story. And what did they say? Strong labor growth should continue to support consumer spending and underpin growth in coming quarters. So basically any news that's bad news, well, that's in the past, but we've got this great quarter coming up. We've got this great half coming up. And again, it ties into the Fed, because if the Fed just saw 0.9% growth in the first quarter, 1.1 in the second quarter, why do they think that you're going to get 3%, 4% growth to justify on a forward-looking basis a rate hike in September? They haven't seen data that would indicate the economy is growing, so why raise rates? There's other reason to raise rates. I'm thinking the way the Fed thinks. Now, the big day, Friday. This is the day Janet Yellen is going to speak, and people are going to figure out what's going on with interest rates. But really, this day is designed to boost the dollar index. So what happens in the morning? Fed President Bullard, Mr. Dove. But no, September might be a good time to raise rates. He's towing the party line here. He says don't raise rates just to lower them. Bad rate guidance has hurt the Fed's credibility. So basically what he's trying to say is, hey, we're not stupid. We don't want to just raise them and lower them. We're going to raise them in September, and then we're going to keep raising them, and we're going to undo this credibility problem we have. That's basically what he's trying to say. Cleveland Fed president, I watched this live. She was on CNBC. She said all this with a straight face. Not that I don't think she doesn't believe that interest rates should rise. She says we need gradual upward pace of interest rates. But then the rationale she gives, I don't believe. She says in the second half, we're going to have strength in the second half of the year. 3% growth. Yeah, we're on track, she says, for a pickup in growth in the second half. Inflation is moving up. And then she said, and then Steve Leisman, who does a pretty decent job of kind of trying to pin them down, these Fed presidents, she says when he asked her about whether they're going to raise interest rates in September, she tried to obfuscate. And she said every meeting is a live meeting. And he said, yeah, okay, but what about September? And she says, well, timing's not that important. He says, what are you talking about? Almost like that's the stupidest thing he's ever heard. Of course, timing is important. Traders, people are making financial decisions based on September, not based on, well, whether you think at some point in the future it might make sense to raise rates. But anyway, that's what she said. So now you got Bullard, you got Meister. They're both laying the case for, yeah, we're raising rates. Now they've echoed Fisher, Lockhart, Williams, and Dudley. They're all talking rate hikes for September. So now it's unanimous. So then Yellen comes out and she yaks and she talks about, well, the economy's picking up. Everything is wonderful. And I look at the Fed website and look at her speech, and I get to the point pretty quickly at the bottom where it says she's talking about $2 trillion in QE could be used to fight the next recession. She also said that they could do broader asset purchases. So this next QE won't be just buying government bonds and buying mortgage-backed securities from the too big to fail banks. Maybe they would buy corporate bonds. Maybe the broader asset purchases might mean maybe they buy U.S. equities. I thought that was a stunner. So I wrote immediately after let's see, it's 10:07 there. It's a few minutes after the speech. Forget the Yellen rate quarter point hike. She's talking about $2 trillion in QE and buying anything that they feel like buying. And that's how the market kind of took it. The market went, the gold price got hit immediately when the speech was released, but then a few minutes later the gold price rebounded and started heading towards the moon because people realized what's more important is not a quarter rate hike point or the possibility of it, but that this woman is talking about, she's talking about future policymakers. But why is she even talking about it? Why does she put in the speech, a QE that might happen? And then I wrote, Fed, we're going to raise rates. We mean it. The economy is robust and solid, but in the outside chance of recession, we'll do the biggest QE in history. That's basically what she said. You can read the speech here. I put a link to it. And she says here, future policymakers might consider some of the additional tools that we've been employed by other central banks. Other central banks, as we've seen above, Norway, Swiss National Bank, they buy equities. They buy mining shares. We could add those to our toolkit. And then basically she says, we can have combined a $2 trillion in asset purchases and guidance that the federal funds rate will depart from the rule by staying lower for longer. So basically, next time you got a problem, she's saying, hey, there's other central banks that do this kind of stuff. They buy assets. They keep rates lower for longer. They put them into negative territory. And by the way, QE, that's not emergency policy anymore. That's in the toolkit. We've done it 3 times already. Well, that was enough to set the markets off. That put the dollar index down. That put gold up. And then Stanley Fischer comes on CNBC and very soberly states that Yellen's comments are consistent with a possible September rate hike. And immediately people start worrying, and it's Friday afternoon. You don't want to be in a trade over the weekend. So the dollar index goes up, the gold and silver go down, and people start focusing on what's in front of their face. And one of the things he said was, and again, he does this to kind of stretch it out so that people don't forget his comments on Monday. He says that Friday, job report is important. That'll really be key in helping us determine. Now, if the job report is really good, then everyone's going to think rate hike. If the job report's really bad, everyone's going to think no rate hike. So what do you think the Fed wants? Well, they either want a very bad report, so they don't have to do a rate hike. They want an okay Fed report, so people continue to wait and think, what are they going to do? Or if they really need to raise rates for their credibility, they can get a really good good jobs report and then raise rates. They will do whatever they need to do depending on where the dollar index is. If people discount that they're going to raise rates and the dollar index falls, there'll be a good jobs report. If the dollar index stays high in the jobs report, then they'll make sure the jobs report is okay. So they don't really have to do anything. They'll say, well, we need to wait and see. So what they really don't want is a definitive moment so that they have to do something. They like to keep pushing things out. And I think the last thing I want to mention, 2 last things, is I did a quick survey of JP Morgan and their gold and silver mining holdings. I remember, just like Deutsche Bank, JP Morgan doesn't own the gold and silver mining shares. Their investment managers own them on behalf of their customers. But I also went through The other types of silver that are under control for JP Morgan, what they've got in their COMEX vault, what they're custodian for in the SLV trust, and then Ted Butler's theory that they also own silver eagles and silver maples. You can check that out. There's a podcast on it. And finally, I mentioned above, Dan Popescu had done a article on a Romanian bank, the largest Romanian bank, selling gold directly to customers, 3 tons over the last 8 years. There was an interesting article he did on, in general, on Romania and gold. You could check out his work if you're interested in learning about SDRs or learning about the London Gold Pool, the Zurich Gold Pool. You can check out his website at popescogold.com.wordpress.com. Thanks again for listening, and also remember, please subscribe to smallgold.com, put your email address in here, subscribe to the YouTube channel. The reason I prefer the smallgold.com is you never know what's going to happen with YouTube. You've seen it on Twitter, people getting banned, accounts disappearing on YouTube. I think if you're on the Small Gold website, I post the YouTubes anyway on Small Gold, and if YouTube somehow goes away, I've got a backup Vimeo account. I can do other types of podcasts. So please subscribe to the smallgold.com website and subscribe to the YouTube channel. Thank you very much.